All right, guys, thank you. So how many people in here, when they got invited to this conference, asked the marketer, hey, are you going to have Oxford Life there? I want to talk to them about annuities. Anybody? One, two, liars. Okay. As Eric said, we are not, our basis historically is not annuities. We've done some annuities in the past, but we've got a couple really good ones that I'm here to talk to you about today. Before we do that, I want you to stretch your necks a little bit. I'm a sports fan, and for any of you that are baseball fans, I heard on the way in that David Price was pitching in spring training yesterday, and he got pulled after the second inning. And when asked why he got pulled from the game, the report was he towed his neck too vigorously between innings so he couldn't continue. So I figured if a professional baseball player could hurt his neck that easily, we should all stretch our necks a little bit before we get going into my presentation. So as we go, as you see on the screen right now, I'm going to start with our annuity that's actually the oldest annuity we've got out right now. It's called Income Protector. It's a 5-year multi-year guarantee annuity. Anybody in here sell fixed annuities? Now, if I gave you something different, would the rest of you consider selling fixed annuities? If I had the only product on the market that you could offer zero competition with what you were talking to your clients, would the rest of you go, oh, I'd think about that, Jim? Well, that's what I've got here today. So with Income Protector, for those of you, I know it's a mixed crowd with annuities knowledge. Basically, it's a 5-year guarantee annuity. So it's a true 5-year walk-away product. So what that means is your clients give you premium. After 5 years, they can say, thanks a lot, give me my accumulation value, I'm going to walk. No surrender charge, no MVA. We're going to guarantee the interest rates for that whole 5 years. One thing we don't do is we don't go, hey, we're going to give you a big inflated rate the first year and then give you a point or two lower years 2 through 5. The rate we give you is the rate for the whole 5 years. After that 5 years, like I said, there's that 30-day window. Again, there's no MVA, no surrender charge, nothing. It's a real walkaway. Now, that bottom point on the screen, a lot of people look at and say, Jim, it's only got a 1% guaranteed interest rate. That sucks. Well, let me tell you, there's no point that your client's going to have this annuity where that rate's going to be at 1% where they can't walk away. I mean, think about it. It's a 5-year guarantee. You sell the policy now, their rate's guaranteed for 5 years. Then what happens? They've got a 30-day window to walk away. We're going to redeclare interest rates when we send them that 30-day notice. So they're going to know what the renewal interest rate is. And then after year 10, they're out of surrender completely. So while it's only got a 1% guarantee, keep in mind there's no time that they will have this annuity where they couldn't walk if they didn't like the credited rate. Oops, excuse me. So when we talk about things, you know, there's a lot of companies out there in these products that do a lot of good things, but a lot of the agents that call me and the marketing groups that call me say, hey, Jim, what about accessing money? What can our clients do? Well, with our product, 2 things. In the first year, they can take interest only. They can do it systematically. So if they want a monthly interest-only payment for the first year, it's included, it's free. After that, they can take 10% penalty-free every year from there out. Now, as you see on the bottom of the screen, this is how the surrender schedule works with this product. It's based on a 10-year chassis. But as I said, it is a 5-year walk-away product because of that 30-day window. So any of you go and sit with clients and talk about 10, 12, 14-year surrenders, and the client looks at you and says, I don't want to lock up my money for that long. I know I used to when I was out there selling. Well, this is a great alternative. On top of that, as you're talking to clients and putting money in fixed account, it's in index annuities that are crediting 1.5% to that money, This is another alternative to that, and I'll get into a little more why in just a moment. And on top of that, this is a great CD alternative, as most of you know already. It's a guaranteed interest rate for the whole period. All right, so for those of you who ever done a multi-year guarantee annuity before, this is the basics of how they work. Now keep in mind, this is a hypothetical example to a point. Actually, the first 5 years are what our credited rate is right now on our high band, which is 3% credited. So as you can see, in the first 5 years, they get interest credited at a specific amount. The next, we're going to reset if they keep money in there for 6 through 10. Makes sense, right? It's what every other 5-year MYGA does. But this is what Oxford Life did, I think. Maybe? Okay, any of you ever had an aha moment? Last year, we were sitting around going, what can set us apart? Nobody in the annuity industry thinks of us when they think of who am I going to write my annuity business with? Well, this is what we came up with. We're the only carrier, period, bar none, that has a 5-year MYGA with an income rider on it. The way the income rider works, as you see here, it grows at a 5% higher rate than the credited rate during that period. So, for example, in the first 5 years, if we're crediting 3% to the accumulation account, the roll-up rate's grown at 8%, compounded, not simple. If we re-up the next 5 years at a 3.5, the roll-up rate's 8.5%. Well, as you guys know, we're in a very low interest rate environment. In 5 years, who knows what the credited rate could be on this? It could be 4. How would you like to be able to talk to your clients and go, you know, realistically, there's a possibility you're going to have a 4% credited rate and a 9% roll-up rate in this product. So this is what it looks like when you get back to it. We married the two. Now, who in here thinks income riders cost too much? Anybody? I know I do. A couple of you? Well, anybody want to guess how much this one costs? 0.0. It doesn't cost a penny. So if you're sitting here going, Jim, why would I bother with a client that's buying a MYGA trying to talk to him about an income rider? I challenge you and say, why wouldn't you, right? It doesn't cost them anything. On top of that, it's included in the policy. They do not have an option not to take it. There's no benefit not to taking it. It can only do them good. So as we look at this, now, those of you who have sold income riders before, the key thing I like to say about income riders is they're only as good as the check they're going to generate your clients when they utilize the income rider. Well, I tell you guys, we've done a lot of work. We've talked to the guys here at Brokers Alliance, and one thing I've heard across the board is, wow, your guys' payout factors are extremely competitive. Again, it's a free income rider with an ultra-competitive payout rate, and they can do joint as well on the income. So let's look at how it works. So in this demonstration, you've got a client that purchased this policy at 60 years old with $100,000. The credited rate right now would be 3%. They decide in their 6th contract year that they want to start utilizing the income rider. So we look at the payout factor, which is 5.5% for a 66-year-old. We multiply that by the accelerated account value, which is now over $159,000, and can generate that person almost $8,800 a year, every year for the rest of their life. And by the way, again, that benefit didn't cost them a penny. Is it starting to sink in? I mean, I've had people call me. I was in my office working while most of you were here doing the life stuff yesterday, and I had a guy call me from Florida and said, Jim, I used to run an actuarial firm. how can you guys do this? And I kind of laugh a little bit, and I said, I don't know, I'm not an actuary, you tell me, but I've been assured we can do this. And really, when you think about it, guys, why do these work? Where does the money stay when somebody uses an income stream? They stay with the carrier, right? It's not a cash-out option. So how a carrier can do this is because instead of your client cashing out $119,000 and taking it away, we've got the rest. So that's how. I'm pulling the curtain back, guys. This is Oz. That's how we can do it. But I'd rather you know than you wonder, or you being concerned with, wait, something's not right here. It doesn't make sense. How can they do things like this? So as we move forward, this is the basics of the income rider. It's basically, for a client to use it, they have to be at least 50 years old and have had the policy for one contract year. It's on every policy, whether they buy it at 18 or 80. So those are the only two factors. The income account value is used for the basis of calculating the income rider. So it's the accelerated, right now 8% on our high band. And by the way, I just want to reiterate that the rider cost is 0. Now, I've had a lot of questions since we had this product about what happens to the income rider in years 11 plus. So since I'm up here and I'm going to try and steal somebody's question, what we do is in years 11 and out, the income rider is still going to grow compounded. It just grows at the same rate as the credited rate. But they've already grown it at that accelerated rate, which right now is an 8% compounded growth. On top of everything else, Oxford Life is a company that was based on working with people. We're based on working with a lot of senior clients. We've got included, for no additional charge in our policy, waive our withdrawal charges for terminal illness, home health care, and nursing home. Now, I get questions on this a lot. Jim, what's the benefit? Is it 50% of the accumulation value? The answer is no. It's 100% included in the policy at no extra charge. Now, for those of you who've been selling annuities and companies have banded interest rates on their products, when I was out in the market selling, to get a high band with a company, it was typically about $100,000 in premium. Guys, our high band is $25,000. I'd say that fits most of the clients we work with on a daily basis in the annuity market. But if you've got somebody who has $10,000 to $24,999, we'll still take the business. And it only credits at half a point lower, so you're at 2.5, and they still have a 7.5% compounded income rider that's included in the policy. This is the basics of the product as we've already talked about. It's got 5-year guaranteed sets of interest rates. Has that 30-day window where they can walk away. It does have an MVA, but the MVA doesn't come into play. Has the no cost included GLWB, or the guaranteed lifetime withdrawal benefit, the income rider. We'll take clients 18 to 80, and again, we'll take as little as 10,000 and as much as 350,000. Now guys, I'm going to be honest with you. If you call me up and say, Jim, or you call Eric or Aaron and say, Jim, I've got a client with $500,000, will Oxford Life take it? I get those calls all day, every day, and the answer is no. Let's set the stage. Our company, until last month, would only take $250,000 without home office approval. We're up to $350,000. That's a big jump for us. What does that do for us as a carrier? Well, for those of you who have been in this marketplace for very long, a couple years ago, what happened about August, July? Carriers pulled products from you and said, we won't take any more premium. We've had enough. This helps us throttle that to where this is a sustainable product for our carrier for a long time. You won't have to worry about that with us. We do have a calculator on our website, so if you want to show a demonstration, just one second. We've got it where you can show. I just put a page on so you can see that we have it. You can sit down with your clients. It'll tell you what their income is every year. Yes? Yeah. The question is, if they have more than 350 and it's husband and wife, would we take that? And the answer is yes. Our maximum is based on per person. To give you an example, we had a case, it was a total of about $979,000. It was actually 3 people. It was the husband, the wife, and the sister was an executor and trustee of a trust, so we could take all 3 cases. Just to let you know really quick, we also do things some carriers don't do for you. You want to get some marketing material printed up for an insert in the newspaper. You want to do something like that? I can get something like this printed and mailed out to you for $40 per 1,000 pieces with your name and phone number, email address, website, whatever you need on it. We also have a few other things that aren't in this presentation. If you guys need to do stuff like, anybody here got an AT&T cell phone, a Sprint, or an Nextel cell phone? Just for being appointed with us, you get a discount. Anybody in here buy Apple products? Just for being appointed with us, you get a discount now with Apple. Now, I put this on the screen because this is our contest for this product right now. And when I say contest, it's not really a contest. If you write $1 million in premium on Income Protector this year, I'm going to buy you and send you an iPad 3. If it's not out yet, I've already got agents that have cracked $1 million. And if they don't want to wait, I'll send them an iPad 2. But it's your choice. So write me $1 million and you'll get that. This is where the product's available, just to give you a rough idea. If anybody in here is from California, we will be there soon. I do have a 5-year product with the same rates there, just doesn't have an income rider. So if you have questions about that, talk to Aaron or Rich, and they'll let you know. So now, I'm going to step into probably the most exciting product I've worked with since I've been in the industry. I call it new old school. When I was out selling indexes, every company and their brother had a 10-year surrender, 10% bonus, indexed annuity. I mean, it was the flavor of the month. And then as the market changed, what happened? Companies tried to get innovative, right? Sometimes I think they got more confusing than innovative, but whatever. It's semantics, what you call it. They wanted to do rainbow indexes and stuff like that. Well, ours is simple. And for those of you who are new in the annuity market, this is the basics of what an index does. It lets them participate in the upside of the stock market without the downside risks of owning stock. So what does that really mean to a client? Well, let's look at it. In front of you is the SP 500 average for the last 78 years from 1928 when it started to 2006. Got it? For those of you in the back, there will be a test on what these numbers are later. So in that time, what did we have? We had 50 up years of the SP 500 Index, right? That's pretty good. If you said 2/3 were good years, that's great, right? Well, guys, with that, we had 28 down years. So what does that mean? Let's take caps and everything away from it and just talk simple. If a client put in $100,000 back in 1928 and just let it ride, what would they have ended up with in 2006? It's on the screen for somebody who's up there. But for those of you in the back that may not have super eagle eyes, they would have had $5.8 million. It's not bad, but it took a long time to get there, right? I don't have 78 years for my money to get where I want it to go. I'm not that young. Maybe my 3-year-old does, if he's lucky. So let's look into the advantages of an index and the concept of an indexed annuity. So if you took that 78 years, same $100,000, right? Apples to apples. And instead of those 28 down years, all that person participated was the up years. Anybody want to guess what that number would be? 37 million? Zero cap. 100% participation, zero cap. Katie, bar the doors. You participate in every gain and you don't lose a penny. 50? 200? Anybody else? Guys, you aren't even close. How about $461.5 million? Now, while that's not exactly what an index does, because let's be honest, there are caps and stuff, but conceptually, for those of you who are looking for a way to explain this to your client and what the power of what an index can do for them, this is a pretty good example. Now, whoever said $200 million, give one of the guys your name and address. I'm going to send you a little prize. He's right over here in the front row. So this is the base product we've got. Both of our products are single premium annuities. As long as it's with the app or a transfer that comes in with the app, we'll take it. Okay? They cannot add money in year 2 or 6 months or 2.5 years. It's in about 35 states. We've got a few more that were filed. When we are finished with this, it'll be in about 42 states. There's a few we don't do business in. It has a guaranteed lifetime withdrawal benefit. Now, I'm newer to the annuity industry from a carrier side. Anybody in here want to tell me what an average cost of a guaranteed lifetime withdrawal benefit on a 10-year index is? 95 basis points? Anybody disagree? That's pretty close. I mean, we haven't put them all out, but that's about, I figure 85, 95 basis points. Guys, ours is 50 basis points. Want to cut that cost in half? Sell ours. And it's only on the account value. It's not on the income account value. So if you're selling this to trigger lifetime guaranteed income, we don't hit them with the cost of our income rider. Yeah. Question was, is that guaranteed? And the answer is yes. This has basically the same exact hardship withdrawals that we've already been through, included in the policy at no extra charge. It's on a simple 10-year surrender schedule, which we'll get into in a moment. It's got a 10% premium bonus. Now, the premium bonus is vested, and I'll show you how that works. And then we do 3 crediting strategies. For those of you who are tired of the confusion of, well, this one and that one and that one, and basically you have to tie yourself in a pretzel while you're talking to the client, right? These are simple. If I'm new in the annuity industry and I want to sell indexes, it doesn't get any more simple than our crediting strategies. Now, the 10% premium bonus, one of the questions I get a lot is, hey Jim, is the premium bonus in the account value? And the answer is yes. But it's also in the income account from day one. So when your client gets their policy, it's going to show the 10% bonus when it's delivered. These are our surrender schedules. Anybody in here sell a 10-year surrender that starts at 14 or higher percent? A couple people are laughing. Ours start at 10. People ask, hey Jim, how can you guys get this product approved? And the answer is simple. The NAIC guidelines for a 10-year annuity right now, if you're doing what we're doing, you have to start at 10, and it has to be a smooth surrender schedule. It has to go down 1 point a year or better and be very smooth starting at 10%. That's how we can do it. That's how we get it approved. Anybody in here from Texas? You're from Texas? Okay. One question I get, because Texas is in my region, is, hey, Jim, your product's approved in Texas. Is it a light version? The answer is no, it's the same product. That's how we got it approved there. Anybody in here from Minnesota? No. Okay, then I won't tell you. Sorry. On the bottom of the screen is how the recapture of the bonus, or how the vesting of the bonus works. Basically, guys, it's a 10-year vested bonus. 10% divided by 10 is 1, right? So every contract year they've had the policy, they've vested 1% of the total bonus, or 10% of the bonus, which is 1%. Now on the screen, this screen always confuses people because they say, Jim, if you've got a 10% surrender, why is your gross surrender 18.2%? Any of you thinking that same thing? You're shaking your head, Ken. Yeah, basically all it is because we credit the bonus up front. It's a way to explain to your clients how that worked, and it's a way to do simple math for them. So you say, Mr. and Mrs. Client, you gave Oxford Life $100,000. When you got your policy, it showed $110,000. If you surrender in year 1, you have vested 0 of that extra $10,000 that Oxford Life gave you. So it's just a way for you to do simple math. It's not smoke and mirrors. It's not additional surrender charge hidden. It's just a recapture of the bonus. This is the guaranteed lifetime withdrawal benefit on this product. It has a 8% roll-up rate, and by the way, guys, compounded, not simple interest. You want growth? You want compounded. We've already talked about the income rider only costs 50 basis points. And by the way, it's only on the account value. This slide, when we first had it, and the reason the word both is in there, and I left it in there for a point. When we rolled out this product, this slide said both the account value and the income account value. We printed 500 brochures. I took them to some of the biggest marketing groups you would think. And all of a sudden, we get a call. And while it was horrifying, it was the best call I could have got on this product. It said, Jim, we made a mistake. It's only on the account value. We do not reduce the income account, the 50 basis points. So it's added value to your clients. It does have a step-up feature, so if the account value ever exceeds the income account value, which would happen if the income account value was triggered, and then the account value grows, we'll step it up to equal the account value. So your clients won't lose money. They'll actually gain in their payout factor. It guarantees lifetime payments. And these are the payout factors. Again, extremely competitive in this arena. And guys, I've given, for those of you who are writing down our payout factors, they have 75 kits here with brochures for both products. So if you'd rather not make a bunch of notes, because when I make notes, I forget what I was making notes about by the time I go back and read them. They have brochures that have the payout factors and stuff here. Just to give you an idea, for those of you who are either new to annuities or new to income riders, this is just a way to explain or illustrate the difference in the growth of both. On the left side, you have a hypothetical example of the indexed account. Some years are up, some years are down, as far as 0, meaning down in an index. And on the right side, you have the illustrated growth of the income account growing at an 8% compounded rate that included the 10% bonus up front. Liquidity features. People want their money. Hey, when can we withdraw? After the first contract year, you can take 10%. It's pretty standard. By the way, again, after the first contract year, they can get 100% if they become terminally ill, have to go in a nursing home, or have a chronic illness. And we have pretty standard annuitization options. So nothing confusing, groundbreaking here, but we have the ones that are utilized. So this is the basic product features. It's available for people 18 to 80. We will take $20,000 minimum on this, qualified and non-qualified, and up to $350,000, again, for that throttling to make sure we can sustain a good rate on this product. Yes? Yes, it is RMD friendly. The death benefit, it's the account value upon the death of the owner. This is owner driven. For those of you who are newer in this marketplace, that means if the annuitant dies, the owner has 60 days to either name a new annuitant or they become the annuitant. That's how it works. Then if they die, the owner, that is, then the death benefit or the account value is paid out. And by the way, guys, the 10% bonus is fully vested at death. It does have an MVA. Anybody in here hate explaining MVAs to your clients? I know I did. So this is the easiest way, as we get closer to the end of this, is I talk to agents all the time and I say, look at it this way. You talk to your client and you say, look, if you went up to Oxford Life and you said, I'm going to sign a 10-year contract for you to buy stock. Is that fair? And sure, yeah, okay. Now, what's going to happen if in 4 years you decide you don't want to own that stock anymore? Well, Oxford Life's going to have to sell it. If they lose money on that stock, you're going to participate in the loss because you broke the contract. If they gain money on that stock, you're going to participate in that gain because when you took that contract and you broke it, Oxford Life actually came out ahead. So that's the way I explain it. And putting it in a simpler term seems to be easier for clients and, frankly, some of my agents to understand. It does have the income rider. It has to be added at issue. So I get all the time, what if an agent sells a policy to a client that's 45 years old? They have to buy the income rider if they're going to want it at any time. They can buy the income rider. It can be canceled at any time, though. So if you have an agent or you guys go out and you sell this, and the client goes, yeah, I think I want it, and then after 5 years they don't want it anymore, okay, call us up, fill out a form. We won't charge them anymore for it. And again, same utilization options on this income rider as the other one. Now, as you guys work with your clients, I truly believe the most important thing when you sit down with the client, when you're talking about money, is value. And that's what we give in these products. This product gives them a 10% bonus, a 10% surrender, an income rider that only costs them 50 basis points of their account value only. I mean, I don't know. You guys see more companies than I do. There's not much out there, in my opinion, on a 10-year chassis that even competes. We have, just yesterday, while I was in the office, an income account value calculator on our website. So you can show them, if you put in X, this is what you'll get, and this is what your payment will be when you utilize that income account rider. This is where it's approved now. For those of you who are maybe from Missouri, California, Pennsylvania, any of you from there, they're filed there. They're coming. Missouri should be soon. One thing about Missouri, it won't have an MVA. Check with Brokers Alliance when they tell you it's approved. It'll have another tweak in it, which I won't get into right now. These are our rates. So as you see on the top, Income Protector right now, our high band, which is only $25,000 or more, 3%. Our caps are 3% on the index. And by the way, any of you like to go on trips? Free trips that somebody else pays for? Myra does. I guess she's the only one. Well, Myra, one of these guys, when they write premium for me, they'll give you their trip. Guys, when I wrote annuities, it was 1.2, 1.5, $2 million to qualify for a trip. With Oxford Life, you come on ours for $735,000 in written premium this year. Every 200K more, extra night, on us. Or bring a kid, on us. So this is just the back of the brochure. And with that, I'm done. Anybody have any questions?